Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, I welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Naomi Clark, Head of Investment Product Management at USSIM, to the show. Welcome, Naomi.
Thanks, Charlotte. I'm delighted to be on the show with you today.
It's great to have you here. Do tell us, what is your news story of the week?
So my news story of the week is an article from the Financial Times. Wild temperature swings are becoming the new normal, EU agency says.
And tell us, what made you choose this as your news story of the week?
So, well, a number of perspectives, really, or a number of reasons. I thought the article was really interesting, how it focused on the recent heatwave that we've seen in the UK, but also more broadly in Europe. And the fact that, you know, these kind of unusually early and intense heat waves are really demonstrating how climate extremes are becoming the new normal across the world. And this just really kind of resonates with me, particularly sort of thinking about a lot of work that we do at USS around the energy transition. I mean, for us, these climate change is just a hugely significant financial risk that's really reshaping the investment landscape globally. And the small changes like the one that's mentioned in this article in environmental variables like temperature or sea level can trigger sort of really disproportionately large impacts, not only communities, but also ecosystems and financial economies. From our perspective, traditional economic models really underestimate these risks. And we believe that climate change could threaten the stability of entire systems. So, yeah, this really resonated with me, thinking about a lot of the work that we do internally and in conjunction with academics like Transition Risk Exeter on this topic.
Yeah, and I mean, this is a topic that obviously has been at the heart of sort of the investment industry for a long time. I think sometimes what we put quite a lot of burden on investors and asset owners. Like, even if you do have the odd 80 billion to invest, you can't do everything. We do need policymakers to get involved. Can you talk to us why that is so important to have policymakers thinking about climate change and the risks it's actually going to pose to the economy?
Yeah, I mean, I think that's exactly sort of what we believe. We believe that governments, regulators need to play a really decisive role in accelerating the transition to sort of clean and renewable energy. And these, if we see or when we see clear, coherent, credible policy frameworks, it really reduces uncertainty, which in turn lowers the cost of capital and can unlock significant private investment at scale. Sort of in contrast to that, when you see policy volatility, when you see weak regulation, when you see inconsistent signals coming from governments and regulators, the transition just slows down. This raises costs for everyone, it raises risks for everyone. I think also what we see or what we believe from our recent research is that what we need in the early stages of the transition in terms of policy landscape aren't the same as at the later stages. And it actually won't be the same across different sectors or countries. So what we need is really tailored policies, but we also need kind of clear commitments and longer term frameworks from government to support progress at every stage of the transition. I think if we have this, it's pretty encouraging for investors. I think the transition to clean energy presents probably one of the biggest investment opportunities of our time. And a fast transition will save global economies trillions in energy costs. So, you know, there's real positives, I think, in this sort of potentially quite negative news article if decisive action can be taken.
Yeah, and I mean, it's great that you think that. One of the kind of like irritations of working in the financial services industry, and particularly with sort of asset owners and asset managers sometimes, is you feel like everybody forgets they're in a regulated industry, and that people kind of, and I'm not saying this is USS at all, people kind of moan and whinge when sort of regulation and policy lands on their lap, but they haven't done anything to shape it. So how are you taking the bull by the horns and moving, you know, because you have a good position, a strong position, and you can campaign effectively and people are going to listen to what you say. So what are you doing to make that climate change policy happen?
Yeah, I mean, we sort of hope people will listen to us. We're quite a large scheme. We've got about £80 billion worth of assets, and we support the academic sector, so we're not kind of asset gathering or asset raising trying to grow our business. We focus purely on serving the academic community and the kind of 350 odd employers that are part of our scheme. But we work, our corporate affairs team sort of works tirelessly to work with governments and regulators. But recently we've realised that actually this isn't something we can solve on our own, and so we've actually convened a group of UK asset owners together. And we've been working really hard to try to convince other UK asset owners to join with us in some of this governmental or regulatory, intervention is maybe a strong word, but making sure that regulators understand the financial benefits to the sector. And I think also, particularly in the UK, we look at pensions, and it's getting a lot more interest from the government than it ever has done in my sort of 15 years I've been in pensions. And with things like the Mansion House, the Sterling 20, the government expects a reasonable amount from the pensions sector, and I think it views it as a significant opportunity to drive growth in the UK. I think that does give us as a sector some leverage. It certainly gives us more opportunities to have conversations with governments and policymakers that perhaps we wouldn't have had 10 years ago. And so I think if we can get a group together, as we have done, and we can agree on some things that we think are particularly important, like, for example, electrification of the economy, having that collective group singing from the same hymn sheet, whether it's publicly or privately. And we really recognise that different schemes will have different kind of levels of appetite, opportunity, risk tolerance around what they can and can't say in public versus private environments, or even in consultation responses to government. But I think if we're all asking for the same things, then we can be much more powerful as a group. And so we at USS have been working really hard on that all of this year. And we're starting to see some real positive, some sort of positive action, and the group is now identifying topics that we can commonly agree on. So it will continue to be a huge area of focus for not just the rest of this year, but well into the following year.
And that kind of feels like it's a bit, maybe in the UK it's less situation, but it feels like it's a bit harder to do than it used to be, because we've seen those big groups, international groups of investors like Climate Action 100 Plus kind of be eroded over in recent years. And we're seeing obviously a very different policy direction in the US compared to the UK and Europe. But the thing about climate change is that it's a bit like technology, really, isn't it? And it's not a specific country problem. It is a global problem, and it is a problem that you do have to solve globally, because even if the UK had the most forward-thinking, climate change policy in the world, and we were already completely transitioned and didn't use any carbon in our economy, we would still be at the whim of what everybody else in the world does. So can't really stop at our borders. Do you take that campaigning fight beyond the UK internationally?
Sort of interesting timing to have this conversation. I actually just came back from Singapore yesterday, where I've been meeting with a group of global asset owners, predominantly pension funds, sovereign wealth funds, and speaking actually to them, trying to kind of convince them to join us in this systemic stewardship activity. And I think it was a really well attended forum run by the International Centre for Pensions Management, which is kind of an academic body. And because it was just a collection of asset owners and pension funds, there was an ability to have really good conversations, kind of effectively behind closed doors, without any sort of service providers, asset managers in the room. I was really encouraged by what I heard from many other peer funds globally. And I was pretty clear about what we were doing in the UK and what I thought we needed to be doing globally, because of course the Australian government isn't very interested in what USS is doing, or really any other UK funds, quite reasonably. But they will be very interested if large portions of the Australian superannuation market are lobbying on these topics. And in some countries like Australia, for example, the super funds are enormous and have huge economic power. Some of the Canadian funds, and actually we even had really good conversations with some of the American funds, like, notwithstanding some of the challenges that are happening in the US. But I think it's definitely not impossible to do.
Yeah, no, I think that's, it's the right thing to do. I mean, the kind of countervailing wind to all of that, right, is that, as we can see from this year in the whole Strait of Hormuz situation, we live in a time of kind of fragile geopolitical volatility, and we've got more volatility in geopolitics now than we used to, and that tends not to be conducive to the long term. So is that a concern of yours, and is there anything you can do to kind of mitigate against that?
Yeah, and I mean, look, I think we also shouldn't be too negative. Like, I think obviously some of what's happened in the Strait of Hormuz has actually been directly really, really beneficial for the electrification of economies globally. And in the US, you've definitely got some political headwinds against things like wind, for example, which is clearly not a topic that Trump is keen to pursue at the moment.
Nice pun there, though. I love that, Naomi. Headwinds against wind.
but there have been other real beneficiaries, and actually, there's been lots of other real advances in renewable energy, even within the US, which I think have directly been driven by some of these challenges around energy security. And I think also when we look at AI and the energy consumption needs of AI and people looking forward to that, it's pulling forward the transition, which I think is really positive. And perhaps sometimes we are a bit kind of doom and gloom about these things. But I think there are some real positives that are going on under the surface. And in other emerging market economies as well, there's been really significant progress in the last kind of 6 months to a year that potentially wouldn't have happened without those two driving forces.
I mean, you are right. The upside of geopolitical risk is as soon as oil price spikes, and everybody starts thinking about the security of their energy supply, number one, and then number two, the economics of the green transition start to add up because the oil price has spiked. So there is an upside for transition from a more fragile geopolitical situation, even if it does make it trickier to kind of get the long-term policy change and the cohesive global policy changes.
I think that's right. But we still have pulled forward some of the activity, and that will remain, which I think is really positive. And I think coupled with really strong policy, we can be in a really good position in the medium term. But we do need that strong policy, and we do need to. It won't happen on its own, I imagine.
No, and if people don't speak up and try and make the changes, then they're never going to happen, right?
Yeah, absolutely.
So we are the Professional Investment Podcast, and we love talking about policy here because everything, as we said, we're in a regulated sector, so policy does influence everything that we do. Sometimes it gets forgotten, but you can see from how all the different pots of capital invest and how different that is, just how important regulation and policy is. But if we would kind of like to look a bit closer at your actual investment portfolio, can you talk to us a bit more about how you think about climate change risk or transition risk when you're actually designing that portfolio, and what levers you do have to pull and what levers you don't have to pull?
Yeah, I think there's two ways of looking at it, or two ways that we look at it at USS. So we're a universal owner. We've got a really large pool of capital that we have to invest. So for us, the option of not owning things is not really available to us. We're effectively sort of exposed to everything in the market, and we can't kind of stock pick our way out of these risks. And we can't even really stock pick our way out of specific country exposures. Like we are exposed to the macro economy, and that's challenging. And I think for us, that's why systemic stewardship or policy maker intervention is basically. I mean, this hasn't always been our approach, by the way, but for the last few years, I think the view really is, that is almost like an investment response, that we really feel that the best way for us to have kind of a good market to invest in the medium to long term, it is using all the tools in our toolbox to do as much systemic stewardship as we possibly can. And that's why we're putting a huge amount of effort into this, and why we really would love to work with other asset owners. And we think it's really financially material to outcomes for our members. So although it's, it doesn't seem like a kind of investment activity, and historically we might have been more concerned about engaging with specific companies, we might have thought about excluding companies. I think for us, we sort of feel that, we can get much better return on investment of our time by undertaking these wider systemic stewardship activities. And we believe it is genuinely financially material to our scheme. And I think what's led us to that is the other sort of way that we look at this. And the other thing I would talk about, which kind of came first a few years ago, but we started working with the University of Exeter around looking at climate transition scenario analysis. And really that's where we've developed some much more qualitative scenarios that think about different ways in which climate change, but also actually increasingly things like geopolitical risk play out. And we use these scenarios when we're constructing our asset allocation to think about how we can build resilience into our portfolio. I mean, we're largely a defined benefit scheme, and we have a fiduciary obligation to pay pension benefits as they fall due, and that is ultimately what we all get out of bed to do, to make sure that academics can have great financial stability in retirement. When we look at these scenarios, we see the impact of climate change, and we aim to build diversified and resilient portfolios. But looking at these scenarios ultimately leads us to the belief that actually we can't really mitigate this risk in any material way. There are too many potential kind of tipping points and other factors that are modelled in. So much as we can create as resilient portfolios as possible, and we look at things like physical risks across our portfolio, we're working on incorporating nature and biodiversity risk into kind of our heat maps. We know it's not the answer, and we know that there needs to be more. We know we need more policy intervention. Yeah.
So that research with Exeter kind of like took the scales from your eyes, so to speak, and kind of revealed the scale of the problem, and that that engagement or diversification or
exactly
isn't really going to help.
I think so. Because, for example, you can there is kind of a temptation to believe that energy transition can succeed through financial markets, like reallocating capital, like decarbonising portfolios, divesting from the worst or highest emitters. And like those tools do matter to an extent, but ultimately you sell a polluting asset which reduces the individual portfolio's carbon footprint. But what does that do to reduce real world emissions? Like these assets don't disappear when we sell them. They're owned by someone else, and it might be that that's actually someone with less incentive to drive change for that organisation. So for us, we think that if we're genuinely targeting decarbonisation, we have to help these high emitting sectors transition, not walk away from them.
That's the point. You can have the most perfect, beautiful green portfolio in the world, and you could stand on your doorstep and still see the planet burn around you, right? It's not necessarily going to help. I would say that you have to go brown to go green, and you have to, what your point is, you have to sort of get your hands dirty. I just wonder, in terms of, like you've decided that you really do need to do systemic change and policy change, what does that mean for kind of like the engagement side? Does that de-emphasize it, or is this just something that you just want to be realistic about the changes that you can make there and run this program at the same time? I think those two, are they in parallel, or is one more important than the other?
They are definitely in parallel, and I think we will always engage with the companies that we own. Like, we're an active owner, where our managers are active owners, we expect them to be engaged with the companies they own. And I think it's, we must be genuinely good, high quality stewards of all the assets that we own, and we must make sure we have clear engagement plans, and we hold companies to account. We make sure that for us, it's actually really important to track engagement activity to understand, well, is it that we talk to this company for, twice a year for 3 years and nothing happens? I mean, that doesn't demonstrate that they're listening to their investors. So that is material to us. And we engage on a wide range of issues with companies, actually, obviously not just climate change, many other financially material risks. And I think it is a big part of what we do. But I think realism is kind of the word you use. And I think that's right. I think it's about being realistic about what any individual shareholder can achieve with a company, relative to a group of shareholders who might represent hundreds of £billions of assets, speaking to governments who genuinely want those pounds invested in their local economies, and who probably actually need and want those pounds invested in the energy transition to a certain extent, and just making sure that the policies are there to support that investment. Because without that stable policy landscape, it is really difficult for capital to be deployed. And it's helping governments and regulators to understand that, really. So it is very much a joined up effort between kind of all different teams within the organisation. And I think we would not want to be sort of misconstrued to be saying that we think company engagement is not working or not useful. I think it's absolutely useful. I think it's imperative for managers to engage with their companies. It's a hygiene factor for me, really, when I look at our internal or external managers. It just is. I don't think you can do that and think you've done everything.
It's, as you said, and you reiterate what I said. Yeah, it's the dose of realism about it all, which is good. It's always good to be pragmatic and realistic rather than live in pink fluffy clouds, I think. And we talked about, that you've come to this conclusion about systemic risk, that, that needs to be done. And we talked about diversification. We've talked about allocating to private markets. I mean, do you see that as a way to manage the risk within your portfolio, even if it's not as perfect as you would like it to be? But does private markets give you a good way to invest in all of that green tech and in the transition? Or can you do that? Can you do that kind of transition through the universal ownership of big passive equities as well?
I mean, I think we have a belief that we want to build diversified, resilient portfolios, and we allocate a lot to private markets, kind of globally, but also a lot within the UK. We do allocate to renewables. And we also spend a lot of time on the asset management of our assets that we own. We own a lot of our assets directly ourselves. And obviously there you have more control, and you can engage, asset manage the activity much more and we've had some really great successes with some assets that we've owned around kind of increasing the energy efficiency of those assets. And we also do own some renewables and that sort of thing as well. I think, for us, kind of, it all goes back to the portfolio construction point and the scenario analysis that we use, and that being the main tool that we drive to think about the resilience of our portfolios and the exposures that they face to different scenarios, different plausible long-term scenarios. And that's really, everything starts there. It's a pretty sort of disciplined approach, and we find the scenario analysis incredibly valuable.
So is there, as a universal asset owner, do you, I understand your logic. I think we've explained that well. As a universal asset owner, when you did this research with Exeter, it led you to understand that you have to do more, that it has to be about systemic change. You have to make those policy changes. Aside from that and the engagement process, is there anything else that you can do or that you feel stymied by because you can't make sufficient changes as that universal asset owner?
Don't think sort of particularly. I think, I think it's probably no secret that we'd like to see faster pace. We'd like to see things progressing more kind of domestically and internationally. We'd like to probably see more asset owners coming together to do this kind of good work, understanding that different schemes have kind of different ways of working, and understanding that actually I think a lot of meaningful conversations don't play out publicly. They play out privately. And so I think, often it's quite difficult to kind of understand and measure the success of those sorts of things. But yeah, I think that's probably our main aim at the moment, really.
Yeah, and I mean, one thing I've learned from these 20 years of being involved in this sector is you can kind of have some broad brushstrokes about how different within different pots of capital, but basically it seems to me that every single pension scheme provider or insurance company or master trust, closed DB scheme, everybody has their own peculiarities, and their open DB scheme too. Just no one is the same. There is no real one size fits all. There is no shortcut. It is about, really, if you're an asset manager and trying to sell to that market, you really have to take your time to get to know everybody who could be a potential client. It's a very, very heterogeneous sector, and we kind of understand why, because it's sort of evolved over time, and regulation and stuff has changed it, and it's kind of layers upon layers. It's not, if you were to start today with a blank sheet of paper, you wouldn't start here, right? But we are where we are, and so the complexity is kind of built, and fragmentation is built into the system, which makes it harder, right?
But I think in the UK we are moving quickly towards a more homogenous market, particularly in DC, with a lot of the consolidation and much larger pools of capital as well. So we've been probably the largest pension fund in the UK for a pretty long time, and that's no longer the case. And there are some enormous schemes now that are pretty new, and so I think I feel really encouraged actually by the kind of the potential for the potential sort of success of some of this systemic stewardship. When I look now at, we have many more kind of peer funds. There's many more funds looking at internal management. There's many more funds now looking at investing in private markets, even within the DC space. So I think the market is homogenizing, and we are going on a bit of a transition. And if you look at the Australian market, which has obviously been on this journey, a while before us, and look at kind of the product and opportunity set there and the types of investments that are made, I think our market will start to look much more similar to that in the next kind of 5-10 years. It's happening really fast, this consolidation, and I think that does drive a lot of opportunities for investment within the UK economy, as we have more and more of that capital being able to be deployed, particularly private capital, I think, which often, when you look at things like the climate transition, these are often more private market opportunities, far more opportunities for schemes to get together, and far more conversations going on, I think, between the government and some of these large schemes, and between regulators in these large schemes. So I think all the ingredients are really there for the next kind of 5 years, and I think that's probably why for us we feel this time is the right time to be doing a lot more of this activity, both kind of domestically but also internationally.
I mean, you're right. Within a few years' time, we're going to have several 100 billion schemes in the UK. So I'll give you the last word to you, obviously, Naomi. If you could say one thing to other asset owners, what would it be?
I would say let's all join together and collectively think about systemic stewardship. Let's think about the climate transition. Let's think about what we need for the future that our members are going to retire into, and for the economic landscape that we're going to be investing into. And let's be bold. We need bold policy. We need bold asset owners to come forward.
Okay, great. Well, that is a really excellent place for us to end the podcast. So I just want to say thank you so much for being on the podcast, Naomi, given that you've just come back from Singapore. You've done extremely well. I wish I looked as good as you do after a long flight. You look fantastic. You've been a great guest. Thank you for all of your insights and expertise. We really appreciate you sharing that with us.
Well, no, thank you for the opportunity.
It's been wonderful having you on the show. Listeners, if you want to make sure that you never miss a future episode of the Professional Investment Podcast, make sure you hit that subscribe button and do interact with us, share your comments, take part in the Spotify poll if that is the platform you use to consume your podcasts, And as ever, thank you so much for listening.